An LLC taxed as a C corporation. It might sound complex, but this unique tax structure could offer significant advantages for your business. Let's explore what it means, how it works, and whether it's right for you. When you form an LLC, it's typically taxed as a pass-through entity. This means profits flow directly to the owners, who report them on their personal tax returns. However, LLCs have a powerful option. They can elect to be taxed as a C corporation without changing their legal structure. This election creates a separate tax-paying entity. The LLC pays corporate income tax on its profits, currently at a federal rate of 21%. If profits are distributed to owners, they're then taxed again as dividends. This is known as double taxation, but don't let that term scare you off just yet. There are several compelling reasons to consider this tax structure. First, it can lower the overall tax burden for high-profit LLCs that plan to reinvest earnings. It also allows owners who work in the business to receive wages and access better fringe benefits, including robust retirement plans and healthcare options. For businesses eyeing significant growth, C Corp taxation can be particularly attractive. It's often preferred by venture capitalists and private equity investors as it aligns with the typical structure they invest in. It also supports long-term growth strategies, including the potential to go public in the future. However, this structure isn't without drawbacks. The issue of double taxation can be significant if you plan to distribute a large portion of profits to owners. There's also increased administrative complexity, with additional federal and state compliance requirements to navigate. Unlike pass-through entities, owners of an LLC taxed as a C Corp cannot deduct business losses on their personal tax returns. This could be a significant disadvantage for businesses in their early stages or during challenging economic times. If you decide this structure is right for your LLC, the election process involves filing Form 8832 with the IRS. You'll need to include a statement of consent signed by the members, along with their identifying information. When comparing this to other business tax structures, consider factors like pass-through taxation, corporate tax rates, self-employment taxes, flexibility in profit reinvestment, and access to fringe benefits. Each structure has unique implications that can significantly impact your business's profitability and your personal tax situation. So, when should an LLC consider C Corp taxation? It's often most advantageous for businesses with high earnings that plan to reinvest profits rather than distribute them. It's also beneficial for companies seeking robust employee benefits, attracting outside investors, or positioning for long-term, significant growth. In conclusion, electing to have your LLC taxed as a C corporation can offer strategic benefits, but it's not the right choice for every business. It requires careful consideration of your current financial situation, future goals, and overall business strategy. As with any major tax decision, it's wise to consult with legal and financial experts who can provide guidance tailored to your specific circumstances.